Hello, this is Mike Preston at New Harbor Financial. As you can see from ChatGPT, there are some upsides and downsides to investing or going all in AI stocks. Today we're going to talk about AI or artificial intelligence, what it means for you, what the risks and what the opportunities are. So ChatGPT is really driven by AI. This has been out a few years and it's really a phenomenon that people are just catching on to. Remember March 2000, the NASDAQ hit 5,000. Everyone's talking about the new economy. The internet's going to change the world. And it did change the world. But guess what? The stock market still lost about 83% as measured by the NASDAQ. There were great companies back then that still exist. Think about Cisco, for instance. And there were great companies back then that don't exist anymore. So the market can go down even if you've got a great idea, even something revolutionary. No doubt the internet was revolutionary. And we have no doubt that AI or artificial intelligence is revolutionary. But what does it mean for you and what should you do about it? That's what we want to talk about. So companies all over the United States are spending about $500 billion betting on AI. Is it the next internet, or are we repeating the same mistakes, betting on the same bubble that's about to burst? So we're going to try to cut through the hype and give you the real deal here. So first, I'd like to talk about the dot-com parallels and why it's different. Let's start with the uncomfortable truth. There's some eerie similarities between today's AI boom and the dot-com bubble. Here's what, in my view, is the same. There's massive capital investment without clear outcomes or clear returns. Companies are pivoting their entire strategies around this new technology. Valuations, which are already off the charts for the S&P 500 as a whole, are even more insane for these AI companies. And there's this mentality that this time is really different when it comes to AI. Here is a chart that came from a recent article by JP Morgan. It talked about CapEx, which is capital expenditure, i.e. investment, and research and development as a share of revenues. These guys here, Meta, Microsoft, Alphabet, Amazon, these are the big guys. These are the guys that are betting on AI, that are using AI, and that are looking to the future. Meta is investing 60% or so of their entire revenues in this area in AI. The other guys are investing about a third of their revenues. So this is huge, the amount. And these are the big, Mag 7 stocks, or at least these are four of them. So here's a number that should make everyone pause. These four companies, Microsoft, Google, Amazon, and Meta, are projected to spend $596 billion in AI-related infrastructure in 2025 alone. That's almost $600 billion. That's a huge 35% increase from 2024. And these four companies now account for more than half of all capital expenditure growth in the entire U.S. equity market. These are the big guys. These are the movers and shakers. Sound familiar? In 1999, telecom companies spent hundreds of billions laying fiber optic cables for the internet boom. Most of that investment was wasted. Some of those companies don't even exist. When I started in this business in the late 90s, 1999 to be exact, there was a lot of companies that came out and were the rage. I remember Lucent Technologies. Everybody had to have Lucent Technologies. Everyone had to have Nortel. These companies don't exist anymore. And some companies today that are all hype won't exist anymore, and others will. We just don't know. That's why we want you to be careful. This talks about the AI adoption rate by sector. This is the number of companies in these sectors essentially that adopt and use AI in their daily practice. Take a look to the right of the chart. There's this huge parabolic increase in 2025 alone. Take a look at the top line, the blue line, information technology. 70% of infotech companies adopt and use AI. But take a look through all different layers of industry, education, manufacturing, retail, healthcare. They're all using AI, and it's all parabolic, vertical this year. So unlike the dot-com era, which was theoretical by and large, JP Morgan shows AI has already moved beyond experimental phases. Real companies are seeing real results. So the dot-com era was about building infrastructure for future possibilities. The AI era is about deploying technology that already works in a better way. It's about saving time. It's about saving labor. And that's huge for industry. Maybe it's not great for labor, but it's huge for industry, potentially these big companies that I mentioned earlier. Now let's talk about the valuation disconnect. These four companies are spending $596 billion a year on AI infrastructure. And only Microsoft reports AI specific revenues, and that's only 14 billion a year. That's a 40 to 1 spending to revenue ratio. In any other industry, we would call that insane. Take a look at the next chart, also from that article from JP Morgan, which we'll reference in the notes. The relative forward PE of all AI plays. If you look over here on the right-hand side, it's about 1.2 times the S&P 500. Well, the S&P 500 is insanely valued in our research and our estimation here, with a cyclically adjusted PE ratio solidly up in the mid-30s, and even more if you take into account what we think are record profit margins. Take a look here. AI plays back in 2022 were almost 40%. That's 1.4% above the S&P norm. So they have pulled back some, but they're still 20% above an already extended S&P 500 valuation. So yes, they've actually come down, but what does this mean for you? If you're overexposed to AI, think about trimming some here because of the fact that we're off of all-time high valuation levels. I don't think that we can say that that chart says that they're a screaming buy. Valuations are on their way down. You should definitely think about trimming some profits and rebalance. That's a smart investment strategy, no matter who you are, really, and no matter where we are in the cycle. If you've got too much, trim. If you don't have any at all, this is a better entry point than 6 months ago. I think we can at least say that. I can't say they're undervalued, but it's better than back then. And if you wanted to have a little bit of exposure, now's not a terrible time to think about it. Talk to your advisor, talk to us if you want some specific advice. The investment thesis test. Can you explain why your AI holdings will be profitable 3 years from now? If you can't do that, if you don't know why, then you're probably speculating rather than investing. Here's the portfolio risk that most financial advisors aren't discussing. Correlation risk. All stocks tend to move together. All stocks within an industry in particular tend to move together. When one falls, they all fall most of the time. When one goes up, most of the time they all go up. That means you're not really getting the diversification that you think you're getting. Regulatory risk. Governments are just starting to figure out how to regulate AI. A lot of these companies are monopolies or at least oligopolies, meaning that there's only a few players in this field. If governments figure out how to, or they do figure out in the future how to regulate AI and control it, that's generally not a good thing for profit margins. So the government meddling could drive down margins and affect your investment. A concentration risk is real if you're all in one stock. And I've talked to some people that are all in one stock, and it feels great when it works and it feels terrible when it doesn't. But if you're all in one industry, even, it can also be a very, very strong concentration risk. You really should think about diversifying and get some help from a professional if you need it. We'd be happy to talk with you. Timing, you really have to be right about timing. It's another big risk. AI might be great, but if you're too early, it doesn't matter. Oftentimes early movers in an industry will fall and then others will come and pick up the pieces and you might be left out in the cold. So we don't know about the timing. I can't tell you what the timing is. The best thing is to dollar cost average in and diversify and don't have too much all in one basket. So here's a few things you can do to protect your portfolio. Set position size limits. Don't risk more than a certain amount per trade. If you're a trader, like a swing trader, and you're more in and out, you really should never risk more than about 2% of your account on any one idea. If you're more of a buy and hold type person, you might want to have no more than 5% in any single stock. That should keep you a lot safer than going all in. You can think about using stop losses, or either real stop losses in the market or mental stop losses that you will set some kind of alert for and then take action if those stops are hit. Consider international companies too, even though if they're in the same field, you don't get a whole lot of diversification. They're still going to be highly correlated. We really think you should keep international in mind. And don't chase performance. It's really hard emotionally not to chase performance. Stick to your strategy. Don't get emotional and don't chase the hot dot, so to speak. Take it slow. Reality risk. Current AI technology has very significant limitations. As awesome as it still has pretty significant limitations. JP Morgan's research shows even the best AI models have 50% error rates on many tasks. What happens to valuations when these limitations become more apparent? Are they going to be able to meet reality? Are we going to be able to reduce errors? Who knows? The almost 30 years in this business is people's assessment of what they can take psychologically is often drastically different than the reality, and then give some more specific advice. Here at New Harbor, we have a process where we get to know individual clients and we apply a model, assuming that model is suitable for them. And in that model, we're always monitoring various different sectors and different stocks, but our process is to constantly monitor risk and reward and look at what sectors are performing the best. Technology happens to have a place in our portfolio right now. It's one of the strongest sectors, but that's something that you're going to want to stay on top of. If a certain sector changes or if it starts to show relative weakness, we're looking for relative strength. So if you start to see relative weakness, you're going to want to either hedge or think about getting out of that sector and or stock. So there's a few AI stocks out there that I'd like to mention. These are not specific recommendations at all because we don't know your personal situation, but I'd like to mention just a couple AI names that everyone's talking about. Here's a daily chart of Palantir. Palantir is a very large company that's using AI for government contracts. Some people say they're a company that does a lot of kind of spy type work, but it's very futuristic. This company is all about intelligence, and AI is very, very central to what Palantir does. The stock has an insane valuation. It's really, nobody knows if the stock can grow into its valuation, but take a look at what Palantir has done on the weekly chart. It's gone from around 25 to 125 in the last year. That's a five-fold increase. That's a huge gain. And up here, they had really great earnings going back to the daily chart, but the company sold off here on earnings. But as you can see, it's right back to an all-time high. So we'll see what happens to Palantir, but this is certainly a leader in this space. Nvidia, another huge company, almost $4 trillion company, I believe, it's pretty near an all-time high. It's pulled back after the tariff pullback here in April, but it's almost back to an all-time high. Again, a full valuation at NVIDIA. NVIDIA makes the chips that are used to really process a lot of these AI queries. There's newcomers like, for instance, CoreWeave, which is a recent IPO, which is a company that's almost 100% involved in AI. So, but these companies, just as a few examples of companies that are heavily involved, you can even look at an ETF, something like this Global X Robotics Artificial Intelligence ETF, if you want to just buy an ETF. So these are just a couple ideas. I've got to say that it's impossible to tell whether these ideas are good for you. Please have a conversation with us or your financial advisor before investing in any idea. So what's the bottom line for you and your money? Let me give you the straight truth about AI and how it fits into your portfolio and what's likely to happen. Some AI companies are going to become incredibly valuable. Is it going to be the ones I mentioned? It might be. It might be others. You might want to invest in the broad basket of them if you're not sure exactly how to proceed. That's generally the safest way to go because some of those companies will become massive and others will go out of business. It's kind of like throwing a handful of seeds on the ground. Some of them will grow into gigantic oak trees if they're oak seeds. Some of them will be stamped out or pulled or a lawnmower will go over them. But if you have one of them that grows much larger, if one of them goes up 100-fold or even 10-fold, a number of the others could go to zero and you'll still make a lot of money. The technology, I think, will create real value. It already is, but that won't necessarily translate to shareholders. We might already see peak valuations here. That's what's hard to say. We don't know how shareholders will do long term. I'm going to go over a few common portfolio mistakes I see often. First, risking too much. People just think oftentimes an idea is so good they have to go all in. While that does make the Jeff Bezos and the Bill Gates of this world, those guys were all in on their company. They weren't outsiders investing 100% of their money in those companies. They had to make it work, or it was kind of a once in a million type thing. It worked out for them, but there's a lot of others that didn't work out for. And I've seen a lot of times in my career, people go all in on one idea, and it works out to be a disaster. So don't do that. It's just not worth the psychological strain and pressure that'll put you through. Watching too closely. Psychologically, it's really hard not to look every day or every hour at your portfolio and see the minute-to-minute changes. I know a lot of people do that. It's really, really hard not to. Try not to do that. If you can distance yourself just a little bit, you're probably going to find that your results are better. Third is really related to the second mistake, making emotional decisions. You really have to come up with a game plan before you enter a position. Have that mental stop of where you're going to take corrective action. Have your loss control in mind. Otherwise, if you look too closely, you're going to make emotional decisions. If you risk too much on one trade or one idea, you're going to make emotional decisions. And guess what? When you make emotional decisions, you're going to make mistakes. If you can actually create a strategy or build into your strategy how to take advantage of emotions, then perhaps that's something you can work out for yourself. What I mean by that is if you have cascading or waterfall type sell-offs like we did in April, and you weren't already exposed to a given sector like you wanted to be, that's when you want to take advantage of the emotionality in the market to take your position. But a lot of times people are already invested, and as long as you're invested properly, you're not going to make an emotional mistake during times like that. In closing, I guess I'd like to say this. The AI revolution is real. It's already affecting your portfolio, whether you know it or not. The question isn't whether you have AI exposure, it's how much, what kind, and how to manage the inherent risks. That's exactly the kind of portfolio analysis we do here at New Harbor. Reach out to us. We'd be happy to help you. We help our clients already understanding what they already own. We identify concentration risks, and we build strategies that work and capture growth opportunities while thinking about downside risk. We're pretty good at mitigating risk either through options or by telling you to sell down a position or through diversification. To schedule your free portfolio review, please click the link below or give us a call. We'll have an honest conversation about your portfolio and help you understand if any adjustments should be made. The AI revolution is changing how we invest. The question is your portfolio ready for it? Thanks for watching. I look forward to speaking to you soon. And please like this video and subscribe down below. We really appreciate you watching, and we will talk to you soon.